we haven't done the balance sheet part. And if you go to the balance sheet part, the balance sheet part is not very complicated. The balance sheet part is very, very simple. The first part of the balance sheet is, so let me expand this. What is the balance sheet? A balance sheet is simply a breakdown of what you own, what you have, and what you owe, what you need to give back to people, right? What you've borrowed. So on the part that you own, you've got your cash and bank balances, and we've done some calculation here for Maya. This is, by the way, the wrong way of doing cash and bank balances. We'll actually do the right way. We'll highlight that. But for the time being, I'm just saying, you know, I've got a couple of components. The first component is cash. Second component is receivables. So amount of money that people owe us, money that they are going to pay us, right? So in Amaya's case, you know, the payment consolidator does a payment every 15 to 20 days. And so at any given point in time, your outstanding with the payment consolidator is about maybe 2 weeks of sales, 3 weeks of sales, right? So we plug that number here. Your inventory is the stuff that you actually have in stock, and we've plugged in the number here. So we figured out how this number is calculated. And the sum of all of these is your liquid assets. This is stuff that converts. This is stuff that converts into cash, is cash, or converts into cash, you know, in a shorter time cycle. Then you got fixed assets. Fixed assets stuff that they've bought that's going to depreciate over time. In Maya's case right now, we just kept it very simple, basic, and to the point. We just put in two numbers here, which is vehicles, furniture, and fixtures. And we haven't done the warehouse right now. So this model does not include the cost or the impact of the warehouse. If you go to Maya A5, or if you go to Maya E1 or Maya E9, that's a more complete model. But for the time being, I just want to walk you through what the balance sheet components look like. You add these two components together and you've got your fixed assets. So you've got your total assets. So your current assets, which is assets that will convert to cash in a shorter span of time, and your fixed assets, which are long-term assets, right? Stuff that's going to stay with you for a while. These are two components that we kept here. We'll actually revisit this again when we look at gems, but for the time being, this is enough from the balance sheet point of view. So those are your 5 lines. Then you've got your liabilities. Now liabilities, if you've done a bank loan, so if you borrowed money from the bank, you've got your friends and family loans. So in Maya's case, they've borrowed about 300,000 dirhams from immediate family. And the way the cycle works for them is that at the start of the trading cycle, so at the start of the year, they borrow a bit of money from friends and family, and they use that money and their own sources, and they use that money to purchase inventory. And then as that inventory gets sold and money starts to come in, they pay down that debt, and they repeat that cycle. And they've been repeating the cycle for some time now, right? So that's the friend and family loan part. This furniture and fixture net of depreciation means that, you know, you bought it. So let's say, you know, I had a car, or I had furniture, or I had a laptop, and I bought it 3 years ago. And 3 years ago, you know, it was worth X, but I've used it now, right? So I've used it now for about a year or 2 years or 3 years. And each month or each year that I use it, I allocate a certain cost to it. And I say, you know, I've used a certain part of the value of this. So because I've used it, the value is going to come down by a bit. And in accounting term, we use multiple terms for that, but the most common usage for this, you know, allocation of cost of usage over a period of time is a term called depreciation. So how much has the value of the asset gone down because you've used it? So for example, you know, if I have, you know, in Maya's case, let's say they have a shelf, and that shelf has a lifespan of 5 years. They also have a printer that they use for printing, shipping and invoicing, and bills and payments and receipts. And that printer, let's say, has a life of 3 years. And across those 3 years, you know, and let's say that printer costs 10,000 dirhams. So what Maya is going to say, this printer's cost, I can't expense it just in this year. I need to expense it over the next 3 years. So if it's 10,000 dirhams, it's going to be about 3,300 dirhams per year, right? So I'm going to allocate a cost of 3,300 dirhams per year, and the value of this asset will come down by that amount every year. So I'll actually have a schedule. And if I go back to my examples, you know, if we come back here, let me just build it. So if I take a printer, This is my color printer, and the color printer's cost is 10,000 dirhams, and I'm going to say I'm going to use it. It has a life of 3 years. So this is my cost, this is my life. So my cost per year in terms of using that printer is going to be, actually just divide this by here, 10,000 by 3, that's the amount. So that's my usage cost per year. So in year 1 I've used this much, in year 2 I've used this much, in year 3 I've used this much. So if I do the calculation on this basis, I'm essentially saying that every year for the next 3 years I'm going to use this much in value. Sorry, here. So what's the value of the printer? At the end of the first year, it'll be this minus this. At the end of the second year, it's going to be this minus this. At the end of the third year, it's going to be this minus this. It may still be functional. I may still be using it. I may still be able to sell it in the market for 2,000 dirhams, right? But for my accounting purposes, for profitability purposes, for expense purposes, what I want to do is I want to say, I want to allocate the cost of this printer over 3 years. And I've done that using this simple calculation. I've taken the cost, the original purchase price, divided by the number of years, and I've gotten a simple number. And I've just added that to the cost. And what this does is it says, it makes sure that I don't charge the entire cost in 1 year, either the first year or the last year. I actually spread that cost allocation over the next 3 years so that my accounting profit, my actual profitability is reflective of the cost of the components I've used. So that's there. Then on the liability side, this is stuff that you need to pay back in the current year, right? In the current accounting year. So the first is bank credit, second is friend and family loans, third is stuff that you owe to vendors. So payments that you need to make to vendors. So receivable is payments that people owe you. So your cash consolidator, your payment consolidator, your card consolidator, your customers owe you a certain amount. Payables is stuff that you owe to your vendors, payments that you need to make. And that makes us current liabilities. Then you've got bank loans, your total liabilities, and then the difference, this number, net assets. This is a really important figure. This is what your business is worth. So you've got total assets of 27,000. You've got total liability of 66,000. There's a whole of 688,000 in your balance sheet. Why? Where is this whole coming from? I've got this number here, and I've got this number here. So I'm not sure where these numbers are coming from, right? So in this specific case, the reason why you have a big hole in the balance sheet is simply because your cash and bank balances are modeled incorrectly. You've got a 743,000 component. Why? Because you've said my cash and bank balance is going to be a function of sales. It's 4%. So sorry, function of my profitability. My operating income. It's 4% of operating income, and that number, that model, that assessment is incorrect. So we have to fix that. Once we fix that, then we'll figure out how that piece works. So what we've just done is we've just presented a high-level review of our balance sheet, right? But this balance sheet is broken. So there's a debt schedule also here that we've put aside for calculation, basic calculation purposes. This is assuming that rather than renting our warehouse, we actually go out and buy it. So we go to the bank, tell the bank, we've been doing this business for a while. This is what our P&L, this is what our profitability, this is what our balance sheet looks like. Can you please lend us some money so that we can buy the warehouse? And if the bank agrees, gives you the money, you buy the warehouse, and this is the debt schedule that we've used for that calculation. Just like the P&L, right? The P&L we've improved and we've fixed. It's now realistic and believable. The balance sheet though is a mess. It needs to be cleaned up. So the first part that is an issue in the balance sheet is the cash component. The cash component is broken. We have to fix this, right? So how do we have an estimate for cash? One good big solid estimate for cash is our operating income. How much money is coming in or going out? If we fix that, that'll solve some of our problems. So we can do that. So I'm not going to use this 4% here. Just release this completely. I'm simply going to assume that this operating income, this figure here, is a good reflection of cash. Because if you think about this, what is here? Are there any non-cash expenses in this list? Are there any non-cash expenses in this list? This is cash, this is cash, this is cash, this is all cash, this is cash, this is cash, this is also cash, this is cash, this is cash, this is cash, this is cash. This is all cash, right? Now, if we added depreciation, if we added a couple of other components in our expense calculation, then it becomes non-cash. We haven't done that right now. So I can use this as a proxy for cash for right now. So it'll change, right? But where does it go? So this operating income or this net income number, where does this go? It needs to go someplace. So there are two changes I need to make in the balance sheet. And one is I need to calculate equity. So I need to calculate shareholder equity. And shareholder equity for me essentially is if I retain everything that we make in terms of profitability, then my opening balance for equity is going to be my net income figure. So I've used operating income here, but I don't have anything else. I've put in interest expenses as charges, right? Let me go back and put this number here for now. So net income is line number 12. This net income generally should include depreciation and interest and taxes. But for the time being, we're just going to use it as is, and we'll fix this a little later when we come back to fix the model. So I'll just use this net income figure as is here for net income purposes, and this is the figure I'm going to use for my calculations for equity. So if I go back to equity, my shareholder equity, one part of shareholder equity, retained earnings. So what is retained earnings? Retained earnings, whatever we made, we've reinvested back in the business. We haven't taken any money out. We haven't given ourselves a big thick fat dividend. So if I take the retained earning figure from net income above, that's my starting point. That's this one. And next year, what's going to be? It's going to be this number, the previous year's balance, plus this figure. So that's still negative, and then it grows. So then it becomes decent, right? So that's my first figure. All right. My second figure is cash. There has to be some change in cash every year, right? So I must start with something. What did I start with? I had this loan of 300,000 that came from friends and families. And then I had this payable amount of 360,000. So 660,000 is the amount of money that essentially came in different forms and sources, right? So one big challenge here right now is that if you remember when I spoke about statement of cash flows, I go back, sheet 3, sheet 1, options and strategies. So we spoke about statements. When you spoke about financial statements, profit and loss, P&L, profit and loss, P&L. This gives us a sense of dollars coming in, dollars going out, and dollars left with us, right? Dollars left with us is our margin. This is our revenue. These are our expenses. So far, so good. This is what we've done, right? That's what we spend time on. Then you got your balance sheet. Balance sheet is stuff we own, so our assets. stuff we owe are liabilities and net of 1 and 2. So in this specific case, this is assets, this is liabilities, and this is equity or net assets. Then we have another statement that tracks change in cash position. Right? So change in cash position is what? Cash we've used, cash we've received, and net change in cash. So cash we've used is uses, cash we've received is sources. Received, R-E-C-I-E-I-V-E-D, received, cash is sources, right? And this is transferred. Change in cash is what's transferred to the balance sheet. Alright, G. So these are your three statements, right? These are the three statements that you are working with. So far, we've only done the statement of profit and loss, which is dollars coming in, dollars going out, and dollars left with us, right? We started working on the balance sheet, but we very quickly realized that the balance sheet's broken. The balance sheet's broken, why? Because we don't have this. We don't have this change in cash position. We don't have a sense of how much cash is coming in and how much cash is going out. And that's the next part. So before we build the balance sheet, before we sort of fix the balance sheet for Maya, we have to figure out how this change in cash position is calculated.